wrong $50,000 move could have ended up costing my client their healthcare subsidies, and in addition to that, 5xing their deductible. This is an implicit tax and a hidden tax that most advisors miss. Watch on for a discussion of a few things that I think a lot of advisors get wrong and how that affects clients, and definitely watch to the end for some application, hopefully, to your own situation. Hey everyone, I'm Andrew. I'm a CFA charter holder and a CFP professional who has spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. And what I do is I take the learnings from those situations and I give them to you so that you can apply them to your own life. I have a lot of love for my fellow financial advisors, but I have seen some similarities of issues crop up from time to time. And I'll try to give an illustrative example of each and why I think that these are, in many situations, not in the client's best interest. And the first thing that financial advisors tend to get wrong when it comes to retirees is thinking that a probability of success, a Monte Carlo analysis, a high percentage is handed down from God himself as a requirement for a retirement plan to work. And it's just not the case. I've met many advisors over my career who feel like their job is to get a probability of success up to 95, 99%. And divorced from the client's goals, which many times people don't delve that deep into actually, but divorced from the client's goals in the aggregate, you could actually make a better argument that it does harm than good. Because, said differently, the inverse is there's a 95 or a 99% chance of me underspending what I could have in retirement. I'm going to say that again to make sure you understand me. A 95 or 99% probability of success with the Monte Carlo analysis means there is excess cash, excess investments, excess net worth at plan end. And if you've planned conservatively, which most people do already, the inverse of that statement is 99% of the iterations of my retirement plan, I underspent what I could have. And I understand for most people, the goal isn't spend as much money as you can, but I have seen many people unnecessarily tighten the belt. And sometimes at the request of the financial advisor who is either so scared of litigation or people not being honest with their spending habits that they think we need to be overly cautious with the inputs, overly cautious with the Monte Carlo analysis, overly cautious with all of these variables, where in reality, I find some more candid conversations about the trade-offs between the two make a lot more sense. And also, you may have a goal of extremely high probability, but for your fixed income needs. So if you spend $100,000, you may want a 99% chance of being able to spend $50,000 of that every year because that's your property tax, food on the table, those types of things. And so what you do is you break out the plan to multiple pieces and you say, okay, this is the portion I want an extremely high probability of success. This portion, the excess, this is actually legacy or philanthropy or something along those lines. And so we can play the game differently. The second item that I tend to see financial advisors get incorrect for retirees, it's congruent with number one, which is an under allocation to equities. I see this with retiree portfolios, but I especially see it with financial advisors who construct portfolios for clients as well. And I think the intent is most likely good because in practice, most clients, people underestimate their risk tolerance and they become overly risk tolerant whenever markets are good, and they become overly risk averse whenever markets are bad, generally speaking. But if you retire at 60 and you're married, you really need to plan on a 30-year retirement. And not all of those cash flows are needed in years 1, 2, 3, 4, and 5. In practice, what I have found is helpful is if you line out your cash flows, and you've heard me in other videos talk about this, if you adequately line out your cash flows, being able to tell someone, hey, a bear market usually corrects itself within 2 to 3 years. We have your cash flows lined out for the next 5 years. And then in just the aggregate bond index, you have 3 years of cash needs over and above that. So say you need 100,000 a year, you have 5 years of laddered bonds, 3 years of the bond index, 800,000 total in fixed income. Most of the time people go, I have 8 years of high quality fixed income assets. Yeah, I feel like I can take stock risk because I'm allowing the long-term money to stay long-term. And so that may end up being an 80-20 portfolio, depending on your net worth. There's your risk need. So to continue with the idea of the 800,000 in fixed income assets, if you have a net worth of, if you have a portfolio of 1.6 million and you've laddered out those bonds and have that fixed income, that's a 50-50 stock to bond portfolio, 800 in fixed income assets, high quality fixed income assets, 800,000 in equities. Okay. But if you have a $15 million portfolio, but your cash needs are the same, that's overwhelmingly equity head. Risk need is how much risk do you have to take to be able to meet your goals in retirement? I need this minimum rate of return over a period of time to combat inflation, to have asset appreciation for my future income goals. Risk capacity is the inverse of that function, okay? So the person with $15 million has the capacity to take much more risk because their spend rate relative to their net worth is so much lower. And then there's risk tolerance, which is how much risk do you want to take at the end of the day? Well, so many financial advisors get hyper focused on risk mitigation because clients don't want to see their portfolios go down. However, I think sometimes it's from a lack of education and a lack of targeting the duration that the client needs and helping them understand proper cash flow alignment. Many times I've seen portfolios that are 20-30% stocks for a person who's 60 years old, when really it should almost be flip-flopped. All else equal, right? If somebody walks in and they have a low risk need, meaning the required rate of return for their plan to work is 3 or 4% a year, and they have low risk tolerance, they don't like equities, they don't want to deal with equities, well, it's not a big deal. You just don't invest in equities, but you need to have the discussion to understand what you're giving up and the different risks you're taking on. Again, it's about trade-offs. The final piece that I've seen a lot of financial advisors just not be that educated on when it comes to early retirement, and when I say early, I mean pre-65, is the complexities on planning around healthcare and how that works in conjunction with Roth conversions, especially. And I did have a client once who was paying about $100 a month because of the health insurance subsidies and because of the particular plan they were on and how low their projected income for the year was. Their deductible was only about $2,000 as well. And so I started to do some modeling on what if we did a $50,000 Roth conversion to max out their 12% tax bracket. And what I found was that their subsidy would essentially go away. And now they would end up at about $500 to $600 a month for their health insurance premium. And their deductible would go from $2,000 to $10,000, okay, with a similar max out of pocket. And so it becomes this multivariate analysis where you're not just paying the explicit tax on the Roth convert, which is 12% at your marginal rate. You're paying the implicit tax of the reduction of the tax credit. Furthermore, the increase in deductible, if you have a bad healthcare year, right? Let's say the Roth conversion's $50,000, your federal tax on that's 12% tax rate. But in addition to that, your implicit tax, because of the reduction in tax credits, is another about $6,000 because your premium went up. So that's an implicit tax, right? And if you had a bad healthcare year and you end up using your deductible up, that's another $8,000. So the total possible tax, when you include explicit and implicit for the $50,000 Roth conversion, could be $20,000, which is actually a 40% marginal tax rate, which you would hardly ever do a Roth conversion at. especially if you're at a lower net worth level. That's a large tax. But again, if you're myopically focused on it's a 12% tax bracket, you convert the Roth. Well, no, you got to look at everything here. And many times what I have found is you actually want to depress your income in those years. Wait until you get on Medicare and then start the Roth conversion laddering. Every situation is different, but I just use that as an example. It's easy to just throw out recommendations for, hey, you're in a low tax bracket. Everyone loves Roth conversions right now. Therefore, do the Roth conversion. And once you get to looking at it, like most things in life, the devil's in the details. You can be generally correct, but absolutely wrong. So take a look at your own situation and run some analytics, understanding where do I need my probability of success to be? Is my equity and fixed income allocation put in place because of my retirement plan? Or do I have an investment plan and then a retirement plan? And they're not coexisting for the benefit of my family's future. And then also understand there's some complexities around the healthcare planning, and you need someone in your corner, or you need to do the research to really understand what your options are and what the implicit and the explicit taxes are. Until next time, thanks everyone. See y'all.